This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the final lecture on double entry bookkeeping. Remember what we've done so far. We recorded all the transactions in our first example, debit, credit. So they're all recorded in our T accounts. We then went and took a balance on every account. So we know that the cash at the end is 4,100. We know that the total purchases for the period were 1,100, and so on. We then did a trial balance, which wasn't a T account or anything. It was just a quick check on a piece of paper to check that we had done our double entry correctly. As I went through, it won't find all the mistakes, but certainly if the trial balance doesn't balance, there must be a mistake and we'd better find it. Now, though, we're in a position to actually produce our financial statements. And watch me very carefully, because again, this isn't something you'll be doing in the exam, but you need to know what happens, because it's hard to explain until we come to the later chapters, but in later chapters where you've got extracts from things, you'll see it will be important you know what's happening, even though you're not doing it yourself. But if you look at these accounts, some of these accounts are assets or liabilities for the statement of financial position. For instance, cash. Cash is on the statement of financial position. It's an asset. And at the end of our period, we've got cash of 4,100. And of course, we've still got 4,100 at the start of next year. And so next year, we'll use the same T account. There'll be 4,100 there. And next year, there'll be more cash, less cash, and the balance will change. But because it's an asset, and it'll appear in the statement of financial position, and we've still got the asset, we simply leave the balance there. We don't do anything. Leave it there. Use the same T account next year. Similarly, capital and car. You know, we owe the owner 5,000. We still owe the owner 5,000. Leave it there. Cash. We've got a car, 1,000. We've still got a car next year. Leave it there. They'll appear on the statement of financial position. Assets, capital. Payables. Payables. We owe 200. We still owe 200 next year, at the beginning of next year. Next year, presumably, we'll pay it. But that'll appear as a liability on the statement of financial position. We leave it there. When they're assets and liabilities, they're still there next year. We don't do anything. We leave the balances, leave the T accounts as they are. And next year, we'd use the same T accounts to carry on. But look at sales. Sales was simply a list of everything we bought this year. It's not an asset or a liability, it's a list, it's income. We've made sales this year of 1,700. Next year, I want to use the same T account to list next year's sales. I don't want to leave that 1,700 sitting there. And so we'll remove it. And where's it going to appear? Surely sales, its income, it appears in the statement of profit or loss. And so what we do is this. We open one new T account called statement of profit or loss. And we say, okay, sales, that was simply a list. I say again, there is no asset or liability there. It's a list, it's the income this year. We finish this year, we remove it. If I debit with 1,700, the balance is 0. Putting those double lines signifies there's no balance left. The balance is 0, and I could use the same T account next year to list next year's sales. The double entry, debit sales, credit statement of profit or loss. Debit sales, credit statement of profit or loss with, and I've forgotten the figure, 1,700. Jumping back, purchases. Again, there's no asset or liability. There's no inventory left. Worry about that later. There's no inventory. It says, if you look back, we sold everything we bought. That was simply a list of what we bought this year. Next year, I want to use the same account to list what we buy next year. Again, we remove the purchases. It's a debit of 1,100. If I credit with 1,100, the balance is 0. We can use the same account next year. Where are we going to have a double entry? Purchases appear in the statement of profit or loss. Credit purchases, debit statement of profit or loss with 1,100. What are the other accounts? Rent. Rent again is an expense. It's not an asset or a liability. This was simply a list of this year's rent. Next year, I want to list next year's rent. And so we remove it. Credit rent 200. And rent again appears in the statement of profit or loss as an expense. So credit rent, debit statement of profit or loss. The balance is 0. I can use the same account to list next year's rent. Debit statement of profit or loss. Credit rent, debit statement of profit or loss, 200. Receivables. Receivables is an asset which will appear on the statement of financial position. We're owed 400 at the end of this year. We're still owed 400 at the beginning of next year. We'll leave that balance there, and hopefully next year we'll receive the cash. But simply leave it there, do nothing. And similarly, although slightly funny one, drawings. Drawings appears in the statement of financial position. It reduces the amount owed to the owner. Leave the balance there. Now I'm nearly there, but see what's happened. Any balance that appears on statement of financial position, you do nothing. Leave the T account as it is. If it's something that appears on the statement of profit or loss, income, the sales, expenses, the purchases, the receipt, rent, clear the balance. Debit or credit to get a balance of 0. The double entry to statement of profit or loss. I've dealt with them all. Statement of profit or loss, there are 3 figures. I'd better take a balance. What is the balance? The missing figure is 400, the balance. And of course, what is that 400? Surely that's the profit for the year. It's a credit balance because it's owed to the owner. And we've now completely finished with the T accounts. We can now do our pretty statements. First of all, the pretty statement of profit or loss. Well, I know all the figures. They're there in that T account. I know the profit's 400. And so all I'll do in my statement is rewrite the figures in a pretty layout. We went through the layout in the previous chapter. What are the sales? Straight from the T account, 1,700. What's the cost of sales? There were no inventories here, so it's simply the purchases. Where are they? 1,100. So the gross profit is 600. Then we subtract our expenses. The only one here was, what was it? Rent of 200. The net profit. So this statement is simply rewriting the profit and loss T account in the proper layout. What about the statement of financial position? Well, again, in our last chapter, I went through enough about the layout. And what is the layout? We'll list all our assets, but remember they must be split between non-current and current. And how do I know what they are? Well, there's no T account for the statement of financial position, but all the balances that are left in the T accounts are either assets, liabilities, or owner. And so all I do is list the remaining balances. What assets are there? Run through. Oh, there's a balance left on cash. Ah, that's a current asset. Let's list it. Cash, 4,100. I don't touch the balance. I leave the balance there. All I'm doing is listing it. Any others? I'm just going for assets at the moment. So capital isn't. Car is an asset. Let's list it. It's a non-current asset. Any more? Purchases were sent to financial positions. No. There's a balance on payables, but remember that's a liability. Rent, no balance. Sales, no balance. Receivables. That's an asset. There's a balance there. List it. It's a current asset. Oh dear, receivables. I can't spell it. So please, all I'm doing is listing the balances. I'm not touching the T account. Those balances are still there. All I'm doing is listing what's left. What does the business owe? What about capital? From the capital account itself, I think there was a balance there. Yes, we've left the balance there, 5,000 listed. Anything else for the owner? Yes, there was profit. Statement of profit or loss T account. There's a balance there of 400, a credit balance owing to the owner. Listed. What else? Of course, there's a balance still there on drawings. There we are, 100. This is on the other side. Remember, capital and profit were on the credit side, were owing to the owner. Drawings on the debit side. It reduces the amount owing. Listed. So the amount owed to the owner, 5,300. Any balances left? I think there's only one left, isn't there? We've listed that one. We've listed receivables, drawings, sales rent was 0. We listed purchases, I'll come back to payables. We've listed car, capital, cash. The only one left is payables. A balance of 200. It's a current liability, so listed. Now remember, there is another heading, non-current liabilities, but we don't need to show 0 items. So there's no point in showing non-current liabilities 0. But there are current liabilities listed, and there we are. Beautiful. So 2 things there. Remember, statement of financial position. Remember, there's no T account. It's simply a list of the balances remaining. And also, incidentally, you may be aware, we used to call it the balance sheet, and some people still do. People think, oh, it's because it balanced. That's not the reason at all. It was called the balance sheet because it was a list of the balances, that's all. Anyway, it's now called statement of financial position. But there we've gone all the way through. You will see there's one last bit in the notes, tidying up the owner. I'm not going to do that. You can have a read, but you'd never be asked to do it in the exam. It's just that at the moment we've got 3 separate accounts for the owner. The total owing now is 5.3. Well, we now transfer profit and drawings to capital in the T accounts. Have a read, but you wouldn't be asked to do it. Otherwise, there we are, except to lead into the chapters coming. Although that example we've gone all the way through, we've played at being bookkeeper, we recorded the transactions, and we then played at being accountant, getting the balances and actually closing the accounts and producing the statements. However, there are 4 standard problems or adjustments that the accountant has to deal with, which deliberately didn't apply here. I'll just mention what they are, but it's in the next 4 chapters that I'll go through each in turn. But one is inventory. In that here, deliberately, we had sold everything. If you look back, we sold everything we'd bought. There was no inventory left at the end. There could have been, though, and it's a problem the accountant has to sort out when they're preparing the statements. Bookkeeper records what we sell and what we buy, that's all. Accountant would have to sort out any inventory. Well, you'll see there's a chapter coming. I'll go through how we deal with it. Another problem relates to accruals and prepayments, which I mentioned in the previous chapter. You know, here, we may have been using electricity, but not yet had a bill for it. So on the one hand, if we've been using it, there is an expense and it needs to be in the statements. But if we've not had a bill for it, the bookkeeper won't have entered it. It's something the accountant will need to sort out. Something else you may have heard of, but don't worry if you haven't, depreciation. We've got a car and it's there at 1,000, which is what we paid for it. But if we've been using that car for a year, then actually we shouldn't show 1,000. If we've used it for a year, we should show a bit less. Reducing its value is what we call depreciating. Well, it's something the accountant has to deal with. And finally, look at receivables. We're owed 400, and hopefully we'll get paid it next year. But suppose we found out that in fact that person has died and we're never ever going to get that 400. They died leaving no money. Well, it's a bit silly showing ourselves as owed 400 if we're never going to get it. We call it an irrecoverable debt, and we're not going to show 400 if the person's never going to pay. But that's something the accountant has to sort out. And again, it's in one of the next 4 chapters. So I say there are 4 standard adjustments the accountant needs to make. And these you will be tested on, but you'll be tested on each bit of them separately. You're not going to be doing the whole exercise. But we'll go through each in turn: accruals and prepayments, irrecoverable debts, depreciation, and inventory. But that's something to look forward to. It starts to get exciting.